In July 2026, some of the biggest names in the market lined up to back one scooter company. India's largest mutual funds, a two-wheeler giant, even the government of India. Together, they are putting in about 2,500 crore rupees into Ather Energy, a company that started as a college project at IIT Madras. So, why is everyone backing one scooter maker at once? That is what we'll break down, along with the one method behind the raise, a QIP that you will keep seeing in the news. To understand why, let's look at how Ather got here. It's a Bengaluru company that builds electric scooters. Its two founders, Tarun Mehta and Swapnil Jain, both studied engineering design at IIT Madras, and the company was incubated at IIT Madras. So the institute has been part of the story from day one. And from the start, Ather chose to be different rather than cheap. A premium product, its own software, and its own fast-charging network called Ather Grid. Its main rival, Ola Electric, went the other way, chasing low prices and rapid scale. For a while, cheap and fast looked like it was winning. Then service complaints and quality issues piled up for Ola, and its lead slipped. By June 2026, Ather had climbed to number 3 in electric scooters, at around 16% of the market and rising. Ola had fallen to around 8%, less than half of where it once was. Now, let's look at Ather's numbers the way a business analyst would. Last year, its loss shrank to 517 crore. That is down from 812 crore the year before. And the losses fell even as the business grew. Over the same year, revenue jumped more than 60%, crossing 3,600 crore. And in its latest quarter, the loss was less than half of what it was a year earlier, while it sold a record number of scooters. And over the full year, for the first time, the business generated more cash than it spent running day to day. For a young company, that is the real turning point. That is a big reason the share price has jumped. It listed at 321 rupees, and today it is worth about 4 times that. But the strongest vote of confidence did not come from the stock market. It came from the names that just agreed to put fresh money in. So Ather is raising this money because the business is doing well, not because it is running out of cash. And that raise came in 2 parts. The first part is the public share sale to big institutions. This is the part that was oversubscribed more than 8 times. That means for every share on offer, there were more than 8 buyers wanting in. Some of India's biggest mutual funds competed to buy in. Names like HDFC, Axis, and Aditya Birla. Ather raised about 1,300 crore this way. It had set a minimum price of around 1,170 rupees a share, but demand was so strong that it sold them higher at 1,202 rupees each. That sale has now closed, and the shares have gone out to those big investors. The second part is a more strategic round offered to a chosen set of investors. First, Hero MotoCorp committed about 960 crore. For Hero, this is a deliberate strategic move. It leads in petrol bikes but trails in electric, so backing Ather buys it a place in the electric future. Second, and this is important, the government of India is in this round too. Through the India-Japan Fund, a platform backed by the Indian government and a Japanese state bank, 200 crore is going in. It is managed by India's sovereign wealth fund, and it is investing on normal market terms, not as a subsidy. So this is the government's own investment fund backing Ather as a straight business bet, the same way a big private fund would. That is a serious signal about the business. It does not mean the government is calling the share a good buy. And third, the 2 founders themselves are putting in 20 crore each of their own money. When founders keep buying more of their own company, that is called skin in the game. So put it together. Big mutual funds, a strategic giant, a government-backed fund, and the founders all leaning in at once. At this stage, you cannot really ask for a stronger show of confidence than that. And the speed of this whole raise comes down to one method worth understanding. Now that public share sale has a name you will keep seeing, a QIP. It stands for Qualified Institutional Placement, and it is one of the fastest ways a listed Indian company can raise money. Think of it as a fast lane, open only to big investors. Here's how it works. Instead of selling shares to the general public, the company sells a fresh batch of shares straight to large institutions. These are large players such as mutual funds, insurance companies, and pension funds. Since only big, experienced investors are involved, the rules are much simpler. There is no long public document and no waiting months for a fresh approval. The whole thing can be wrapped up in a matter of days. That speed is the point. Picture a company that suddenly sees its chance. Maybe a rival stumbles or its own sales jump. A QIP lets it raise the cash it needs quickly and grab that moment before it passes. Now, a QIP is not open to everyone. Regular retail investors cannot put their money into it directly. It is open only to those large institutions. But even from the outside, a QIP tells you something useful. When the biggest funds compete to get in, and there are far more buyers than shares on offer, that is informed money backing the company. That is how a business analyst reads a company. And Ather is far from alone here. The QIP has become one of the most popular ways to raise money in India right now. Poonawalla FinCorp raised 2,500 crore this way. And from auto parts to pharma, other listed names like Bell Rice Industries and Gujarat Themis Biosin have turned to QIPs of their own. So the next time you see the letters QIP in a headline, you will know exactly what it means. A listed company raising fast money from big institutions to fund its next move. But raising the money is only half the story. So what will Ather do with all that money? Its next move is a big one. On the 29th of August, it unveils its first mass market scooter, a lower priced model built on an all-new platform. And that fresh 2,500 crore is exactly what is meant to fund it. So let's step back and look at the whole picture. Two first-time founders took an idea from a college incubator all the way to a listed company worth tens of thousands of crores. Their college, IIT Madras, backed them early and shared in the win. Their early investors did well. And even everyday retail investors who bought in at listing have grown their money about 4 times over. That is a genuinely good story in Indian business. But the win is only half of what is worth taking away. The other half is the method we just used to see it. We did not predict the share price. We just read the company, its strategy, its numbers, its backers, and its next bet. That is exactly what a management degree trains you to do. In our AI integrated online MBA, you practice this with the tools working analysts use, like Power BI and Tableau AI. It is a UGC entitled degree you can pursue while you keep your job. If you want the full details, the link is in the description. We break down business stories like this one and explain what is really going on behind the headlines. The next time you see a company raising money, ask a single question. Who is putting the money in and what do they see? Try it on any business in the news this week and tell us what you find below. And if there is a company you want us to read like this, name it and subscribe for the next one.